Greetings, everybody. This is Jeff Scott. It's Saturday the 22nd, although it says the 23rd. I always put Sunday's date. It's about 10 in the morning. Obviously, there's no futures out. I hope you're surviving the carnage as bears are partying like it's 2008. Spoiler alert, I'm not going to show you a whole lot of things to buy long unless you're talking about contra ETFs. The market is in fairly rough shape right here, and I'm, for the most part, out of the long side. More to follow. My name is Jeffrey Scott. My email is hgsidoc@gmail.com. If you like this, please hit the like button on YouTube. If you want to get notification of my weekly reviews and not wait for an email to come through some other board, hit subscribe. And there's no charge for anything I do unless you come to a live meeting, and I pay more on your food than you pay me to come. This is for education purposes only. Any recommendation in the spirit of education, not investment advice. I'm a doctor, not a broker. I pay for all my own tools. I use what I want to use. I say what I want to say, and no one pays me to do anything one way or the other. Trading involves risk. You and your loan are solely responsible for any decisions you make. Everybody's seen this before, so I go quickly. I started with Can Slim, Improve My Morales, and Catcher. Highly recommend this books. Taken to the Computer in Hyper Drive by Ian Woodward. This is his partner, Ron Brown. Ian, unfortunately, we lost a couple of years ago. George Lee, a friend and trader from Pacific Northwest of Canada, who I share the podium with multiple times a year. Van Tharp, the king of position size and money management. Cigar from Superior Profit, who's got some unique, interesting, and effective tools. And then my buddy, John Person. John is someone who I met first by buying his tools, attending some seminars, reading his books, started talking to him. Now we've become close friends. And I still use his tools. I have a lot of programs. What you need is TradeStation or Thinkorswim. There's clear benefits to each of them, and I'm stuck without both of them because I have a lot of systems that are on one but not the other. HGSI is my go-to analytic program. Edge Rater's there as well, and I just want to update this just to be fair. And again, no one pays me to do anything, and I pay for the programs just like you pay for the programs. So I've been using a lot lately, and I'm going to add it to number 3. The Q, Edge, Vital, and Elite tools. And we'll talk more about those today or at some other time. Here's a website for highgrowthstock.com. I get nothing if you subscribe, except I do get to call and ask the proprietor to add indicators from time to time, so it doesn't hurt if he has a successful product. Under investment strategies will be lots of movies from me and Ron Brown and others. That was bad English from Ron Brown and I and others. And then a free 30-day trial, no credit card. We are clearly in stage 4. The question is how far and how low will it go? And then you can't be trading stage 4 of fear like you trade stage 2. If you do, you won't have any accounts left by the time this market recovers. So in stage 4, what do? I sell bear call spreads. That means I sell a call at the money, I buy a call out of the money to protect me, and I put the profits from that spread in my pocket. I might sell naked calls and put the premium in my pocket as well. But the problem with naked calls is if I'm wrong and the market turns, they turn into losers, and I rather cap my loss by making it a spread. I will buy puts. I have a number of puts on high flyers. On my Thursday post-webinar, I went through a number of shorts that I was in, and almost every one of them, I not short the stock. I bought puts or have a synthetic put. I will sell calls. I will short stock, and I will go long contra ETFs. If you are in a account that you have minimal ability to short or buy options, no worries. Look at SQQ, DOG, and other contra ETFs that you buy. They feel like a long, but they act like a short. They go up when the market goes down. Sea of Red, you show me the strength, and I'll sell you a bridge over the desert. It is pretty ugly out there, to put it mildly. Major markets tell the story. I'm using a little bit higher resolution. If somebody who has a 1080p can tell me if you can actually see this resolution, that'd be helpful, because it's much better for me to have a higher resolution than the typical 1080 because of the number of indicators on my charts. On the dailies, what can I say? we went sideways and everything, and then we broke through the bottom of the Darvas box, and we should get a move that's equal to the height of that Darvas box. So we're getting close to a bottom, perhaps on the E-minis here. Here's the NASDAQ futures, the Russell futures, the Dow futures there, the Russell futures here. The VIX has gone up in the mid-20s, but it really hasn't gone into the 30, 40, 50 level that we've seen in the past. And the dollar is pretty much going sideways here. On the weekly, you can see again how much of a sell-off we've had. Will we come down to that 23.50 level on the E-minis? That's probably the magnet on the charts right now. The issue then becomes whether we bounce or we break through like we did on the Russell futures. Notice on the VIX on the weekly that we had a 33 reading back earlier this year. And the dollar is above where it started the year, but it's below where it started 2017. So is a dollar high, lower in the middle? I'll take it's in the middle. If we look at the monthly, you could see clearly we've had two very bad months. In fact, if you look to the left and you go back to 2014 in the beginning of, these are really long red bars, and frankly were enough to shake me out of the market. It takes a lot to shake me out of the market. But I'm not going to spend much time here except to say the VIX can go higher and the markets can go lower. Notice that 23.24 is the 50 monthly moving average. Fed's raised, but the rates fall. What is that telling us about the economy or the concern about this world? Here's the falling rates in white, the 10 years and the 30. Notice that the markets turned down with them, no shocker. Falling yield curve, yes, in blue. This is the yield curve. This is the zero line. This is the S&P 500. One thing that I've noticed is that it's when the rates start to go back up, the rates start to go back is when the markets in pink starts to fall. So this is the falling yields, and notice the markets continue to rise, and when the rates start to go up and the yield curve uninverts is when the markets start to fall. So just because the rates are going to cross below the zero line, it doesn't mean immediately that the markets fall. AD lines in white lead the markets lower in yellow. You can see it better here where the AD line in the NYSE is clearly rolled over. Here's the major market ETFs, the diamonds, the Qs, the spiders, the Russells, and the transports. And the one thing that's up are bonds. Breadth reaches significant oversold areas. We are going back to 2009 here. And this is the market. In white, we have the stocks above the 200-day SMA, and we've now knocked off our low for the last 7 years. When you get this oversold, you would expect a bounce. This is where we were last week. These are the stocks above the 40 going back to 2009. And again, we are setting multi-year lows on the degree of oversoldness. 3-month new high, new low is at the zero line, which means we have pretty much no new highs in the market, and you could see how the market is sold off. Historically, these levels have led to market reversals. We'll see if we get one and how long. The daily McClellan, look at that S&P, it's like water coming from a hose, has started to hit levels of minus 220 on the oscillator and minus 34.59 on the summation index, and we've got the lowest level in a couple of years. This is probably getting close to a reversal signal. And the weekly not quite at 34.59. We probably got a little ways to go on the weekly before we're so oversold that we bounce. And again, does not look like this 200-day moving average is just begging for that S&P to come and visit with it on the weekly, 200 weekly moving average, 1,000 daily moving average. Current buckets. Paul Reike put up on the board how impressive it was, and yes, it is. Let's just talk about what this is showing me. On the right, it takes the stocks of the S&P 1500, at least those stocks that were in the S&P 1500 on October 12th. I'll update it at the end of the year. I do it quarterly. 98% of the stocks in the S&P 1500 ran on 12/21 last night. 98% were below the midline on their Bollinger Bands. That is historic. If you look at, there's almost no green nubbins. If you take a 0 to 100, with the first decile on the bottom of the Bollinger Bands, 10, then 20, then 30, up to 100. Below 0 would be stocks below the Bollinger Bands, and greater than 1 would be above. We have 40% of the stocks in the S&P 1500 are below the Bollinger Band. Since they're supposed to be in the Bollinger Bands about 90% of the time, 95% of the time, one would certainly expect that they're going to ultimately revert. When the entire marketplace is too far to one way, it's only a matter of time before you get a reversion. Now I can look at all NASDAQ stocks and all NYSE, and you see a very similar pattern. This is very widespread damage. Now I'll go back in history. On October 10th, I said, wow, look at this. Yeah, not as bad as it is today, by the way, folks. 84% of the stocks were below the Bollinger Bands. A couple days earlier, it was 90%, 88%. And I went onto the HGSI board. Notice it's 92, 94, and 98 now. And I put how bad was today going back to 94. Number of stocks trading below the Bollinger Band is the 45th worst of over 5,000. I think that we might be worse than we were back here. Here's the problem, kids. 10-10, 10-1. Let's step through 10-3, 10-6, 10-7, 10-8, 10-9, 10-10. On 10-10, excuse me, 9-25 and 10-1, 10-10, we had 35% of the stocks, and this is about when the market got worse. Now, this is going back to 2008, and you could see we had over 70% of the stocks and 100% were on in the bad zone. So we can get more oversold. Hopefully, it's not deja vu. HINDY free zone without new highs, you get no HINDY. So next, market tone, it's red. Now the yellow and the brown there just shows you how much volatility is in the market. You don't get that very often. Even volatility in the sectors, which have all sold off. The Canaries are in a steady downtrend. Well, maybe they'll bounce off their channel and move back up some and give people a chance to get out of some trades and give those that like to short a better shorting opportunity. Get a clue. This is part of the programs that I mentioned from Cigar. Let's look at in magenta. You have one-day performance in the sectors. You can see they all were negative, and in 5 days in brown they all were negative. Over 5 days, energy was down 14%, 10% on healthcare, 7% on real estate. There is no place to hide. Looking at the sectors on a 5-day window, we see that utilities have been strong throughout this market pullback, going back, frankly, a year. Consumer discretionary has really popped up over the last couple of weeks. Industrial starting to show some strength, as are materials. That might be a good sign that things are starting to recover. Now over here, I could look at what's moved the most, and the higher the number, the better you are over a 1 day, 2 day, or 5 days. So let's look at what's the strongest over 1 day. Over 1 day, again, real estate. Interestingly, financials are starting to show up here. Hard to believe. And materials. So I was sort of intrigued by the fact that financials have been moving up, even though the market doesn't really show that to me. But you could see it's gone from a 3, 4, 5, 6, 7. And on the 1 day view, it actually got up to a 9. And then I looked at which are the leading of the financials, and it was mortgage REITs, insurance, multi-sector holdings. Regional banks had moved up a lot over the last couple of days. It's hard to see it in their charts. No news and earnings. There's no major U.S. earnings reports this week coming. There are a couple red dots here. You got jobless claims on Thursday, but the monthly unemployment's a week away. That's a John Person term, by the way, monthly unemployment. A relatively light week on news, and I don't see any Fed heads that are going to crash the market by opening their big mouths. And even on Friday, I'll give you the day off. Market thoughts: we failed to hold early rally Friday, finished at lows of the year. Major indices fell from 6.9 to 8.4% on the week. All major indices are firmly in the red on the year. You could see them here. Russell leading it. Fed disappointment led to a hard sell-off Wednesday, but concerns about further tightening and slowing economy in U.S. and world led to further declines as mainstream Fed appear to be looking at a different set of data. While news continues to hammer any rally attempt, tariffs are likely to reduce economic growth. Trump risk rises with growing ex-insiders working with Mueller. Russia, China, North Korea, what's next? Maybe they're going to turn down NAFTA in Congress. And oh yeah, Brexit's struggling to figure out what they're going to do. So I've capitulated. I have a few long positions protected with puts, some shorts of stock, long puts, and a number of contra ETFs. For your information, I'm not ready to initiate a position on Netflix seasonality in the setting of current market disruption. So, I haven't been talking about synthetic longs in months. And there's a reason for that. I haven't been initiating a lot of long positions. And the problem with synthetic longs is you carry some risk if the stock goes against you. The problem with Jeffrey's synthetic or the chicken shit synthetic is you still carry risk because you have a call, a bear, you have a bull put spread, which means you sell a put at the same price as the call you bought and you buy a protective put. So you have some risk there if the stock goes against you. But I am doing some synthetic puts on some of my longs. So let's look at Amazon. On the left, I'm just for demonstration purposes, if you're sitting on shares today that are not protected. Here is Amazon sitting today. Stock closed at $1377.45. You could see it's already posed to open lower on Monday, but this is so early, I ignore that. You could see if the stock price goes up, meaning it moves to the right, you make money. If the stock price goes down, you lose money. Now, I'm not teaching anything there. You already know all that. On the right is a synthetic put or a synthetic, it's not a synthetic put, it's a synthetic short. So let me change that because I do synthetic puts too, and I'll show you how I can make that into a put. Because that's what I've done on most of them. So the synthetic short says I'm going to sell a call at the same price as the stock, and I'm going to buy a put. Notice the cost on this trade. It's essentially a free trade. And what this does is it says if Amazon goes down, I make money. If Amazon goes up, I lose money. Now, naked, that's the exact same risk as shorting a stock. Now, if I put the two of these on top of each other, what do you find? You basically find that you don't do anything. That if the stock drops, you stay whole. If the stock goes up, you stay whole. So this becomes basically, in times of market entropy, an opportunity with no risk and no cost. Well, there is risk, and I'll talk about it, to protect the price of your stock. The risk is you're wrong and the market goes up and you lose the gains that you would have had you been just long the stock. Now, I don't really want to give up my Amazon, so what I might have done is I might have bought a cheap call, maybe 100 points or 150 points away. I don't expect Amazon to go up, at least when I bought it close to 1,700, 1,800, I didn't expect Amazon to go up in one day. But by having a call that's way out of the money, I'm going to increase my cost, but I'm basically protecting my position if there was an outsized move. I'm beginning to think I shouldn't be buying the calls and I should just be protecting my price. So this is a synthetic short to protect the long position. By adding a call, a long call here, I am creating a synthetic put. Why is it a synthetic put? Because I've capped my risk to the upside by buying a protective call. All right, tonight's agenda will be a short top-down review. Maybe I should just call it a bottoms up because there's not a whole lot to buy from a top-down perspective. Again, thank you for joining today, and if you like this, please hit the like button on YouTube and subscribe so you get notification. So let's do a couple things. Let's look at any reason to be hopeful. Start with the E-minis. Here's the E-minis rolling over. Here's the hopeful sound. We are way below the envelope. Markets usually reverse when they get this far stretched below. My high jump is at 0. Now, mind you, I'm in a sell signal with red bars. I'm in a sell signal on the weekly with red bars. I'm in a sell signal on the monthly with red bars. This is about as ugly as it gets. Now, it was interesting. Alexander Elder actually put a bullish thing out Friday morning, which sort of surprised me. And for a while, it looked like it was accurate. But no, I do expect a rebound soon. We don't usually get this far oversold. But, wait till you see something different. I'll be looking for a person buy signal, blue bars, something. This is the E-minis. Now I'm going to sound like a broken record. Let's look at the Dow futures. 0 on the high jump, way over down to the downside. And all of these you're starting to see some evidence of divergences, although they got worked out on Friday because we set new lows on the MACD. I think, let's see. Yep. If I look at the NASDAQ futures, if I look at the Russell futures. So everything looks horrible here. I'm not showing you something you don't know. If I look at the dollar, you'll see something a little bit stronger. Still in a buy signal at the top of its range. But one thing I've noticed where you can ride along the top and along the bottom, it's when you get way out of the envelope you have a problem. The dollar's at 93% on the high jump, so it's getting pretty extended. Just out of curiosity, where were we here? 95. It was at 100% on this bar. It closed lower the next day, I believe. 44. Yep. And it's closed lower again over here. So that high jump bar showed that we were overextended on that green bar. The dollar's the best looking chart I've shown you so far. If the dollar's strong, then you wouldn't expect the metals, gold or silver, to have any strength. And they had bad days on Friday, but they've had a big run-up. Probably it's because of the entropy in the market. Still blue with buy signal on the daily, weekly buy in green, monthly a buy, and that's on gold. And if I look at silver, looks about the same. The one thing I wanted to look at was VIX, so let's just put this here. Just look at the VXX, and you could see how much the VIX has moved. The VXX here is at 47. I've actually been buying long VXX calls. As a dummy, I had sold calls against it at 47 for $1. So we'll see. I can always take those off if I need to. All right, I know I'm uplifting today. It is what it is. Sum up the designer and HGSI. And let's go to broad major market indexes. Hit the warehouse view. $24 instruments. Let's look at top-down view. Let's just quickly look at the cash instead of the futures. In the middle is the S&P 500. When that's in the middle, when it's down 2% on a given day, that just tells you how bad the market is. So what do we see? Falling knife, bingos, lots of phoenixes. We're probably getting close to a reversal. I would expect we're close to a reversal. I just don't know what's going to happen this coming week with it being Christmas. Things don't always happen the way you think when the market participants are out in the Hamptons enjoying a week off. Here is the Dow, falling knife. Here is the NASDAQ, somewhere, the worst. Falling knife. And then lastly, here is the Russell futures. Falling knife. Look at the volume. Maybe that's a good sign. Let's go back to the NASDAQ and see the volume there. Look at the volume that came in on Friday. Maybe this was capitulation. NASDAQ Biotech. You want to see ugly? How do you own that? Here's how you could have made money on this. You could have bought LABD, which is the biotech defensive, and it goes up when biotech is down, and you could see it's breaking out to long-term new highs. All right, so let's go back to, hold on, I screwed up. Not really. Didn't really screw up. I just have to just change something here. We've looked at those. We've looked at the dollar ones. Just look at the dollar again here. They'll play off that with the VIX and a few other things. Dollar, wouldn't you like to own this stock? Cash is king. Cash is king right now. The VIX, the one on the market this week.
Oh my God.
All right. And my dog's had some bleeding issues this weekend. He's got a cyst that has to be removed, and it popped the other day during my webinar. So if you hear my wife screaming about gushing and bleeding, don't be alarmed. It's the dog, and he's fine. The VIX breaking out to multi-month highs. This is going back to February. I guess this is what we're looking for, is a big pop to say that now's the time to get ready to buy. And we looked at gold and silver, and just look here. You can see gold ran into resistance here. I don't know, maybe it's still going to go higher, but the next couple of days will be telling. And silver, which has some industrial applications as well, is well below the 200-day moving average. Now, the other thing I wanted to look at here is we look at from the 52-week moving average for the 52-week high. The oil's down 41%. Small caps are down 26%. Biotech is down 26%. The Russell's down 26%. Drop down to the S&P 500 is down 17% for the highs. The NASDAQ is down 22% from the high. Semis are down 25%. So if you're feeling pain in your portfolio, there's a reason for that. All right, the next thing I usually do is I go to industry groups, and I hit warehouse view, and we have 174 industry groups. And then if I look at two-day force, what are moving up, you can see none. So nothing changed from negative to positive 2 days ago. Shocker. How about over a 5-day period? What's been moved to positive? Nothing. What moved to negative over the last 2 days? Well, it had to be minerals and beverages, the pot beverages and utilities. These were the last holdouts. And if I look at a 5-day window, I see that 96 groups have started moving to the downside over the last 5 days. So this is as bad as it gets, folks. At consumer electronics, oil services, home builders, internet media, exploration, casinos, healthcare, generic pharma, auto parts, home product stores, consumer products, home improvement, biotech, semis, investors, steel. This is like high growth stocks reversed. There's just so many. I'm going to go and look at a couple of the stocks I want to short and show you some of the things that I've been doing. So let me try. One thing I want to do is see. Hopefully this is done. All right. Let me kill the screener. If you have a 4K monitor, you should be able to see why I wanted to use this resolution. You can see my indicators a lot cleaner. Now let's open up. Yeah, we don't have a lot longer to go, folks. There's just not a lot to like in this market, except we're probably getting really close. But close only counts in horseshoes and hand grenades. Don't be first, because odds are you'll be wrong. Actually, that's what I've been telling my son. All right, that'll work. So I went through a lot of longs and shorts. I'm going to look at them in TradeStation because I could show you some of the things that I like about my John Person indicators married up with HGSI and with Cigars Q. A lot of different things going on here. And let's this load up. Perfect. One more and I'll be happy. All right, and then the other thing, sort of let's see if I can't, this will probably shut down TradeStation, but I'm going to risk it. I'm going to go to the App Store and I want to open up a scanner window. I love TradeStation. I've always loved TradeStation, but man, is it a finicky program that all day long I'm restarting it. I'm sure part of it is because I have a lot of indicators and maybe some of them don't play well together. But my God, nonstop. And I should have these here. Let's see. Oh, I don't have them updated. Never mind. All right. I updated them on the other computer. I didn't update them there. Let's look at some of the stocks that I found interesting to the long side and the short side. Astro Tech. And again, I'm not recommending these for anything more than it's probably worth go look at. Cheap stock. So for people like my son with very small accounts, it allows you to buy a stock it's like an option. Why did I find this interesting? I think you could see why. Something happened on Friday. Buy signal on Friday moved up to $5. Here's a week ago, it had a buy signal. Friday, it took out its downtrending resistance. Your downtrending resistance here looks good on the monthly chart. Look how strong the volume is. Now, if my son is watching this, don't go out and put a buy order at the open. It's probably going to pull back some before it goes higher. But something changed here, and look, there's nothing that good out there to buy, so it made my list. Probably the most consistent one to buy. And I'm going to look at this in HGSI as well. This is DM. It's a midstream provider, Dominion Midstream. Why did I like it? It's pulled back to support, trendline support, has a person buy signal. So what I've done here is this is Cigars memory, trendline memory support. Make sure. Yep. And it's auto-populated. This is John's buy signal. Here's the weekly buy signal. On its way up on the monthly. OBV is strong on daily, pulled back a little bit on the weekly, but still above its moving averages. This tells me the daily and the weekly bongos are green, as is the monthly. It's got a buy signal on all three time frames for John Person's indicators. And this looks like a really strong chart, considering the market that we're in. So let's just take a look at it in HGSI DM. And you could see nothing exciting, but a steady uptrend, pays a 7% dividend. Maybe it's a place to hide out during the current market carnage. TGE, I think this is another one of the midstreams. Tallgrass Energy, high close doji on Wednesday, big move up, high close doji on the weekly. I don't like the volume. Came out of a squeeze on Wednesday with a mobile breakout, a pocket pivot, and a kahuna. So a lot to like here as well. On the short side, a lot. I reviewed my shorts that I took last week. Let's just go through some. Amazon. What can you say? Volume is broken down. All the person indicators are red. The bongos are red. Hence why somewhere around 1770, 1780 in the beginning of December, I put on a synthetic. A sell signal at resistance, a sell signal back here at resistance early in the year. That would have been the time to have topped it. Is it shortable again? You know, it's pretty much long in the tooth. I'd rather wait for it to retrace. But yesterday's leaders usually are not tomorrow's leaders. How about Google? A new sell signal on the weekly, a low close doji on the daily. Now this green dart says that make sure that we've got some MACD divergence, but sometimes that can go on for quite some time, and all it takes is one further dump. And notice that we had a low close doji right off a trend line resistance. If it's green, it's support. If it's red, it's resistance. Volume is falling. Everything is red below. Google, shortable. Ugh. Of course, if the market rallies, you don't want to be short any of these. Intuitive Surgical. Monthly sell, weekly sell with a low close doji breaking through support. Big downtrend here. Here's resistance. Look, this is a stock that's got competition coming. It's overhyped, overpriced. They've got great tools. You can put a stop somewhere above this bar and short the stock or buy puts. When the market rallies, these guys will jump big time. So be careful. CMG, another old winner, dying, an expensive stock. Volume is broken down. Squeezes work both ways. It broke out of a squeeze to the downside and it came down hard. Again, maybe let these retrace before you short them. Boeing. Here's resistance. Here's resistance. It's breaking down. Again, here's a MACD divergence. You can see it on the histogram. You didn't make a lower low, although you made a lower low on price. These are all look horrible. They may give you better opportunities to short after a rally. Mercado Libre, the eBay of South America, a new weekly sell. It's in a daily sell, breaking down. Here's support. I'd want to see it break through support, but look at volume turning down. Everything's red. Illumina. This one I would not short right here because it's got all kinds of weekly memory support drawn here by Cigar. But look at the daily. It looks horrible. Downtrend with a recent sell signal. Wait till it gives you a better opportunity. Roper. I never understood why this stock was a $200 stock. Probably doesn't have a big float, although everything has 500,000 volume. It wouldn't be here. Weekly sell, breaking through memory, support, resistance, right under resistance. Set your stop above resistance, trail it down. This looks shortable right here. Look at volume breaking down finally. Netflix, why am I not initiating my seasonality call? Because I got to wait for it to be done going down. And here's resistance. You want to short them at resistance. It just broke down below resistance. Volume is turned down. And you have a mobile breakdown from a squeeze with a pocket pivot to the downside and a PSAR reversal. Who would want to initiate a long position? Not yet. United Healthcare. A lot of the payers look weak. At some point, the government's going to probably start working, going after them. And with ACA being under assault, ACA really helped the major payers. So you got breakdowns on the weekly and the daily breaking through support, and I could look at a lot and see that. Thermo Scientific Fisher. Breaking down below support, here's resistance on the daily. Volumes all look awful. Becton Dickinson, BDX. Breaking through support, volume leading to the downside. Adobe. Sitting at support, I probably wouldn't be jumping to short it right here. It's on weekly and daily support, but it's sold off hard. Align, Invisalign. Why is this stock so expensive? It's sold off hard, and you might say it's done going down. You know what? It's run right up into the moving average. Had a bad day on Friday. Volume looks questionable, so I might not short it yet. But boy, it's sitting right below resistance on the daily. If I get a person sell signal come in here, I'd probably be looking to short it again right underneath resistance. FactSet Research, I actually use them. Look at this low close doji through support. Look at the volume rolling over. You can use these moving averages or the high of the day as your stop. Arista Networks. I could go on and on and on. How about MasterCard? Now, I'll be the first to admit I'd rather be shorting these stocks back here when they're breaking down. But with this market in free fall, I'm still looking to short. Shopify took 10 days ago or 6 days ago, and you could see Shopify. I took it after this bar on the weekly, and Shopify, and it had a daily sell, and there was resistance up there. Keysight was in a squeeze, and it broke down to the downside on Wednesday. OBV turning over. So there is a lot here to short. And there's probably hundreds more. I just ran out of interest in looking at any more. So let's try and put a ribbon on this. This is a very difficult and challenging market. At some point, this market is going to bounce. Let's go to the S&P 500 and let's start to hypothesize what that might look like. I will just use the spiders. We were in a box. And you can draw it in lots of places. I'm just going to draw it right there. All right. That box was between among friends. Hold on a second. Among friends, that box was $7.5%, and with a change, 20 point box. Okay. One would assume that we're going to get the same 20-point drop down to there. So, based upon this calculation, I get a target there somewhere less than 240. So maybe it's about 238. That's my downside target right now for the spiders. What's going to happen when it bounces? Okay. Let's just extend some of these lines. S&P, the 200, that's the 50, and let's extend the red one too. And I'm just guesstimating what these are going to look like, but let's just say that they're going to look like this. So, scenario one. We trade down to here, we bounce back up to the top of the box, which is right here, which will be where the 50-day moving average is, and guess what happens? Shorting opportunity. I can't draw worse shit. Scenario one. Scenario number two, we run up to the 200. Shorting opportunity. Scenario number three, to the top of the box. Shorting opportunity. And scenario number four, which is the happy scenario, is we pull back up here and go on to new highs. I think those are the most likely scenarios, and the one that I've tried to avoid, I'll just put the black cloud on, is we just go down to new lows. that's certainly possible too. Now let's look at fibs. Let's go from the top here to where I think we're going to end up. Let's see if we can't find some areas that are interesting. There's your 50% retracement. God, I love it when it works out like this. There's your 38% retracement. And there's your 76% retracement. So, pick your folly. What I'd like to be doing now is see a rally, take whatever profits I've got left on my long positions on the way up, and short when we roll over again. I'm not convinced this is over. By the way, I didn't pre-plan this analysis. I just thought of it as we went, and it's amazing how they match up so well with the fib retracements. On that note, I want to wish all the people that watch me a happy and safe holiday season. Drive safe, watch the alcohol. This too shall pass. And we'll see you probably in the beginning of the year. If it's a slow market over the next week with the holiday, I will not be doing this video. If there's a reversal or something big happens, I'll be back. Goodbye, everybody, and thank you again for watching.